All right, good morning, everyone, and welcome to NJCPCU iDay Day 2. We're here with Rob Galbraith, who's going to be talking to us about the end of insurance as we know it. Rob is an author with Insurance Nerds with over 25 years of industry experience. He's been called the patron saint of insurtech, a global insurtech thought leader, a wonderful motivator and inspiration, a mentor to many in the insurance industry, the most interesting man in insurance, which I'd like to know more about, the prophet and the WD-40 of insurance for his versatile skills and ability to solve all manners of problems. Also, which is not in his official bio, has held many leadership positions throughout the CPCU. So he knows all about us. He knows the value that the industry brings and the society. So welcome, Rob, and the floor is yours.
Yeah, thanks, Pat. Really appreciate it. It's so wonderful to be with all of you this morning. So yeah, a former member of the LC, former president of the Alamo chapter here in San Antonio, Texas, where I'm based, former regional governor, and currently serve as the chair of the membership committee. So definitely know the value of CPCU. I got my designation way back in 2003 and have been active at the local and national level as a volunteer ever since. So if for those out there that are not already engaged as a volunteer leader, I highly encourage you to do so within the local chapter. Is a great place to start. I know it's helped my career tremendously and allows me to kind of gain hands-on leadership experience in a time where I didn't have that. I started my career as an analyst, kind of a techie and numbers guy, and so being able to display leadership skills was a challenge in my role, and so the society gave me the opportunity to do that and do that in a safe environment. So huge believer in both the educational value but also the networking and volunteer leadership opportunities with the society. So big fan. But that's not what I'm here to talk to you guys about this morning. I am here to talk to you about yeah, a little bit about my career. I'll start with that, and then my book, The End of Insurance as We Know It, which came out in February of last year and has really just blown up, I guess, to use a technical term. It's found an audience well beyond what I hoped it would do. Using the term a popular insurance book seems like an oxymoron, but it sold thousands of copies, and it's actually been a hit internationally as well. I've had the opportunity since the book was released to speak in Vienna, to speak in London, speak in Sao Paulo, Brazil, Sydney, Australia. I've done remote speeches now in Warsaw, Poland, and Bogota, Colombia, and the book has actually been translated into Farsi. And is currently being translated into Mongolian. So these are all things I would not have anticipated at all when it came out. Can you see my slides? Are you seeing that pop up?
Yes.
Yeah, it's good.
Okay, perfect. Thank you very much for that. And I want to make this section interactive for you guys. So feel free to put comments in the chat, and I will be kind of monitoring the chat on the side and taking time to answer questions. If I don't get to your question during the time, I'll definitely leave some time at the end to have you ask questions as well. So definitely hope to get to all of your questions today. And no, you don't have to write a book report if you win one of the books. Great question, Craig. So a bit about my background to start. I have spent, a couple decades plus in the insurance industry, primarily on the carrier side, mostly in underwriting. Most of that time was spent with USA here in San Antonio, Texas. And what was interesting, very similar to many of you, have been to many CPCU events over the years, and really look forward to networking, seeing fellow insurance professionals. Always, heard great topics. But it was actually 2015 in Indianapolis that kind of, I guess, was the first sign that maybe the world was changing a bit from my perspective. And that was at the annual meeting there. And I met a gentleman from Silicon Valley that actually Tony Cañas introduced me to. And I thought that was curious. So, obviously known about Silicon Valley, know about companies such as, Apple and Amazon, et cetera, but I really hadn't encountered those folks in our insurance industry. And so I asked him what he was, why he was attending the annual meeting, and he said, well, I, hope to learn about the insurance industry. We're very interested in coming into the industry. And I said, well, CBCU at that time, annual meeting, right? What would be now Into Risk is a great place to learn and get a lot of great knowledge and content about the insurance industry. So what are you hoping to do with that information? And he said, well, we're going to go back and, by this time next year, you'll all be out of business. And I was really kind of taken aback. And I was like, oh, well, nice to meet you too. And, if he had been true to his word, that would have been bad because we would have missed Hawaii in 2016. But thankfully that didn't happen. Thankfully, we're all here, still today. But that was really the first sign, I think, that folks outside of our industry were really, really kind of focused on breaking into the insurance market. As you probably know, it's a $5 trillion global market. And so over the course of the next really 5 years up to today, I started interacting with technology firms that were kind of outside the standards of a Verisk or a LexisNexis or some of the traditional vendors that would kind of sell into the insurance space. Not that they weren't still part of the conversation, but starting to come up with a whole bunch of companies. I didn't know their name. They were just a scrappy group of folks coming from Silicon Valley and through Austin, Texas, and elsewhere. A lot coming from Israel, some coming from Australia, and it was really interesting to have them come into our industry and use the term pitch, right? Kind of pitch their technology, give us their sales pitch on how it was going to benefit us, the carrier perspective for some of the underwriting challenges that we had. And it wasn't one technology or one company, but it was just kind of a flood of them. And I got exposed to a lot of different of these startups, and it really led to the writing of the book. It's a very tell people of I was just trying to capture 2 weeks from family and just relax, and I couldn't stop thinking about all these technologies that I'd seen. So I did what they tell you to do, which is write it down. And a couple months later, I realized I had 25 pages, single spaced, of random thoughts, and I kind of realized that I've never written a paper that was more than 10 pages double spaced for college, and maybe there's something here. So I talked to Tony and to Carly Burnham at Insurance Nerds and said, hey, I think I'd like to write a book on this topic. And so they were very supportive. It took about a year to write the book, and it was published in February of 2019. And as I mentioned, just the reception that it's gained in the marketplace has been tremendous, both from career insurance professionals as kind of a wake-up call, so to speak, to say this world is coming. I think we will see more change in the next decade than we have in the 3 decades combined. Change in our industry has looked very steady and very linear over time, but we see that we live in a world of accelerating change, and I'll touch on this point in one of my slides. The world is getting faster. We no longer are doing things the way that we've always done them in other parts of our lives. So it makes sense that it would translate into the insurance space. So a quick backstory before I kind of launch into a deeper dive on this thesis. Pat mentioned in my bio, the most interesting man of insurance. So those are all kind words that people have said about me, or ones that I found were, kind of intriguing and interesting. But the most interesting man in insurance actually came from a podcast that I did back in 2017, where one of my responsibilities at USAA was to manage catastrophe risk. And so I've had the opportunity to actually ride along with the Insurance Institute for Business and Home Safety, or IBHS, in the fields in Nebraska and Wyoming and the Dakotas, chasing hailstorms for a week, which was a very fun experience. Definitely been driving a car at 65 miles an hour down a 2-lane road, and had a hailstorm overtake us, crack the windshield, pretty scary situations. I've also been on the ground following hurricanes. I happened to go to Hawaii to give a talk on wildfire in 2018. And while I was there, we had a 6.9 magnitude earthquake, which precipitated several months of lava flows. So just happened to coincide with my arrival. So I tell people that I personally am quite boring and uninteresting, and a career in underwriting really fit my risk-averse personality. But I've actually had a number of adventures in my life, and they're all thanks to insurance. So hence the most interesting man in insurance. And you can I definitely argue that that's a low bar to to hurdle. So oh, I see that I am starting to lag a bit. So we'll see. Hopefully that'll correct itself. But if it is, we may have to ask folks to turn off videos just to help a little bit with the bandwidth. So I've got a question here already from Pat. There's a lot of players in the sales and distributions, but what about claims? What are the top opportunities in claims? I'll touch on that a little bit later in my presentation, but certainly on the automation side, both from streamlining workflows as well as the idea of taking a picture and through AI can assess vehicle damage. We're seeing that for workers' comp on the ergo side. You've got apps now that can do ergo assessments via AI, et cetera, that I know teams are using for causation and things like that. So there's definitely a lot of exciting technology in the claim space. And I don't know actually if Kiloway is still erupting. I don't believe it is, but somebody can correct me on that. But it took several months, and yeah, it was quite the flow that affected a lot of folks on the Big Island. So the analogy that I like to use here is GPS. So as a kid, I remember very fondly growing up and going on family road trips, and sitting in the back seat. I was an only child, so I wasn't, fighting with my siblings or anything like that. I was very, astutely studying the maps. So very fascinated with where we were going. And so I remember going to AAA and getting those triptychs and kind of following along. Those are some of the fondest memories of my childhood. In fact, some of my early drawings from when I was 3 and 4, instead of sports figures or superheroes, I had things like City Buffalo. I was just really fascinated with maps. But over the past decade, we've really made the change to GPS. And it's actually been a really remarkable change that kind of goes unnoticed in many ways. So maps are not just a decades-old technology that we used to use when we were driving our car, actually a century-old technology that were used by ship captains. Certainly we can think about Lewis and Clark and some of the early explorers and adventurers, and some of the adventures and trials and tribulations they went through simply to map our great country and our great land and really kind of understand our landscape. And so to have such a long-lasting and trusty, relied upon technology such as paper maps go away without so much as a funeral or anything saying kind of thanks maps for all that you did for us, is pretty remarkable. A lot of people still carry, of course, paper maps, but when I ask audiences, nobody really relies on them anymore. We all kind of rely on GPS. And if you think back to the first time you ever used GPS, it might have been kind of a foreign concept to you. I know I had a younger work colleague that did it, and he was able to program the GPS in what he called surfer mode. So the guy was kind of like, hey, dude, you might want to hang a left here at the next light. And we were going to some local burger joint that we weren't sure exactly where it was. And I was like, well, I'm going to have to try this thing out for myself. So one of the remarkable things is, and I talk about this in the opening chapter of the book, is actually going on a road trip with my dad, who's just turned 86 years old, so this a couple of years ago. And so he was unable to drive, so I was kind of driving, but he had commuted between my home state of Michigan and Texas quite a bit. Had been a winter Texan, spent 6 months down here and 6 months up north. And so he knew the route that we were going very, very well, much better than I did. I'd only driven it a couple of times. But yet he would kind of dictate the route as we were driving. And I would always kind of check GPS just to kind of see, right? Like, okay, is that the fastest route really or not? And what was remarkable is, of course, he wasn't always right, but the GPS could take into considerations that he just couldn't possibly know, such as construction that was currently going on in some states on certain roadways. It could take into account the current traffic. I'm sure many of you have had GPS on a route, and it actually tells you, hey, actually turn here. This route is 7 minutes faster than when you first started. I know, particularly driving around the Atlanta area where Tony's from, it's helped me numerous times with kind of some shortcuts based on the current traffic information. And it's made possible because you have sensors in your phone, right? And it can map where you are, where that phone is, as well as all the other people on the road, kind of where their phones are. It all gets transmitted to cloud computing via cellular networks. And then artificial intelligence processes all of this stream, this massive amount of data, and determines through algorithms which are the 2 or 3 optimal routes to go, and then beams it back to your phone in the fractions of seconds. I mean, it's really, really powerful. But again, we don't really think about how it works. We just think of it as GPS, and that's what we use to get around now. But pretty remarkable. And so I kind of share that because a lot of people have said, hey, insurtech, you know, I don't think that it's going to disrupt, or this guys really don't understand insurance, et cetera. And that certainly may be true, but again, you know, the fact that centuries old technology, such as paper maps, could be so easy. GPS, I would, it gives me pause to think that something similar couldn't happen in the insurance industry. The other thing that I think is really kind of notable here is that we're really talking about an entirely new way to quantify and evaluate risk. In the past, we would look at things such as age, gender, and marital status to rate an auto policy. Well, we all know that those things are simply, you know, proxies. It can kind of lump people. So, you know, typically 35-year-old married females do drive better than 18-year-old single males. But we can also think of individual examples where there may be an 8-year-old single male that is a very responsible driver, and a 35-year-old married female that maybe you wouldn't want to get in the car with her behind the wheel. Well, now, of course, with telematics, we can precisely observe the driving behavior and what is going on in that vehicle and how it is being driven. So we don't need some of those old variables such as age, gender, marital status. On the home side, we don't necessarily need to know the age of a home. We know that a home that's 20 to 25 years old could be in great need of maintenance, have all its major systems that are in dire need of replacement, or we know that it could be good for another 20 years because all of that maintenance has been done. We know that the water heaters have been replaced. We know that the plumbing has been upgraded, et cetera. So, you know, certainly, you know, with my dad really not accepting when I would kind of challenge him on the route of, well, the GPS says this route is faster. It's similar for me in my life. I've got 3 children. My youngest daughter is 10 years old. And the way that she uses the Amazon Echoes that we've deployed throughout our house is very, very different. So for me, you know, my interaction looks like something like this. I really substitute Alexa for what I might have checked my smartphone for versus what I might have logged on to a website in past years on versus what I might have flipped on the news for in the past. So I might say, what's the weather forecast today? They'll tell me today it's cloudy with, you know, high 51 degrees. You know, I could ask it sports scores, right? Things like that. But the way that my 10-year-old sees the possibilities for this technology is so much more immersive than what I see as somebody that, you know, is being introduced to this technology for the first time after, you know, 45 years. And so, you know, this experience kind of happened to me last year, and it really kind of struck me. So she had her best friend over, and they were in our master bedroom, and they had the door closed, and I wanted to go in there to get something. And she said, "Daddy, don't come in here." And I said, what are you girls doing in there? Like, usually the master bedroom is not the place you hang out to play. And she says, "We're hanging up your clothes for you." It's like, well, this isn't one of your chores, and you certainly wouldn't want to do that with a friend. Like, this is very bizarre. And so finally they let me in, and this is what I found. I'll show you this quick clip. So she hung up my clothes by taping them to the wall. Haha, very funny. So when I asked her, where did you get this idea? She told me it was from Alexa. And I said, Alexa told you to tape my clothes to the wall? I was like, stunned. I was like, what did you ask? Like, how did this possibly happen? And she said, I just asked it, Alexa, tell me a prank. I would have never imagined in a million years that this type of technology could have this experience. Like, Alexa is an immersive. Her room is right above our room in the master bedroom, and I could never. Each of our 3 kids have their rooms. My other 2 are teenagers, so everyone kind of, you know, likes to stick to themselves, and it's just incredible, you know, the way that she sees the possibilities for this technology. And again, I share that because we live in a world of accelerating change. And the change is getting faster and faster with these emerging technologies. And it's tempting to be in the green part of this chart. This is a very poorly drawn exponential curve. My actuarial friends will tell me, but it's the best I could do. Where, you know, I can say I've been in the insurance industry for the last 20 some years, and this is what changes look like. But it would be a mistake for me to project going forward that will be the pace of change for the next 20 years in the insurance industry. Although that certainly would be the tempting thing to do. And in fact, we're going to see more and more change happening faster and faster. And for those of us that have been in the industry a while, it actually may be harder for us to adjust than it would be for that younger person that's entering the industry for the first time, or that young technologist or entrepreneur, investor from the outside kind of looking in. So just in the way that my 10-year-old saw a lot more possibilities for her Amazon Echo speaker than I ever did, it will be very similar in our industry. And so it's going to be a challenge for many of us to give up the old ways of doing things and to see new possibilities in these technologies. So I like to couch this in what's wrong with insurance today. Like, why do we need some of this technology? Why is there so much funding, so much activity, so much hype around what's known as, you know, insurtech, this term? And insurtech, you know, we've always had technology in insurance. Like that it hasn't really changed. In fact, we have been early adopters of technology, sometimes to our own detriment today. So if you think about when mainframe computers became very popular in the 1960s and 1970s, like many of our core systems are, you know, based on those old mainframe computers. In fact, I remember one time visiting LexisNexis, and they said, you know, we have this old mainframe computer that's just for your company, Rob, just because you haven't upgraded your system. So we need to keep this old machine around so that it can still communicate to your machine and still pass you the information that you purchased from us. And so, you know, contrary to popular belief of, you know, hey, we're still stuck in a paper-based world, we haven't embraced technology, we actually have been an early adopter of technology. But in some ways that's become now a challenge. It's kind of known as technical debt. It's almost like paying things down on your credit card. Now you've got to pay it off, and you have to work really hard if you build up a big balance in your credit card to pay it down. And once you pay it all the way down, you actually haven't invested in the future, right? It's not like you're putting an extra $1,000 on that credit card just to give yourself a credit so that, you know, you have something there when you continue to swipe it. The 7 fatal flaws of insurance, very, very quickly. It's too expensive. And what I mean by that is it costs a lot of money in terms of the household, typical household budget or typical budget for a small business. So if we think about, you know, things that may be equivalent, that's in a monthly budget for a household, we have your electric bill, you have your water bill, things like that. And it's kind of obvious if I don't pay it, like, you know, I'm not going to get electricity, I'm not going to get Wi-Fi, right? Don't pay the water bill, I'm not going to get any water coming out of the tap. So the value propositions, we like to use that term for these, are very, very clear. For insurance, it's a little bit less clear, because if I'm paying that money, you know, every month or every year, if I don't have a claim, right, then that's money that, you know, feels like it's wasted. And we certainly know about the protection that it provides. But it's a significant cost. We know that 40% of Americans live paycheck to paycheck. You know, probably about half of Americans have $1,000 or less in emergency fund, you know, to cover a large loss. And so money matters, you know, to folks. So to the extent that we can help bring the cost of insurance down, not only will we be able to drive adoption, you know, we see the uninsured motorist numbers and you know, many states, depending on the state, it's usually between 1 in 8, 1 in 6 motorists don't have insurance coverage. We can help bring the cost down. Hopefully, you know, we can solve that problem and provide insurance more broadly, more widely, and, you know, again, higher limits, and make sure that it has the coverages that people need. It's too confusing. So again, it's not as simple as a light switch or turning the faucet on and off. So you spend all this money, and now you go to file your claim and you realize, well, you've got a deductible or a sublimit, or that cause of loss isn't covered, et cetera. And so it's, you know, people really don't understand that their mental model of insurance is that I'm paying you premium, that you're storing it in some type of account for me, so that when I have my claim, I'm going to get that money back. And of course, we know that the reality is we're pooling risk. And so, you know, those premiums you paid 10 years ago went to pay losses 10 years ago that other people have that you didn't have. And so now when you have your claim and trying to explain to you all those premiums you've been paying for the past 10 years, that's not stored anywhere to cover this loss, right? That is used to cover other people's loss. And it's now your turn to have the misfortune and their money that we've collected this year from premiums are going to help you. But people certainly don't, you know, have a hard time understanding how insurance works. It's too easy to game the system. So if you think about fraud, the cost of fraud, you think about all the ways we try to fight fraud, you know, those all just drive up the cost of insurance. You are all very familiar with that. It's a cash drain. So in addition to being expensive, insurance also reduces your liquidity. And the analogy I use is credit card. If I were to drop my iPhone and it cracks, that would cost me $1,000 to get a new one. But if I would put that on my credit card, then I have a lot of flexibility. I can pay off $1,000 all at once, or I can pay, you know, $100 a month for a year to pay it off, or I could pay just the minimum balance until maybe I get a Christmas bonus or my annual bonus, and maybe I pay off, you know, to say $300 of it, and then when I get my bonus, I cover the other 700. I have a lot of flexibility in how I use my money to pay off that expense. Whereas in insurance, I don't have that. So that liquidity, that ability to kind of flex is valuable over and above the actual cost. Of course, it doesn't cover all causes of loss. We talk about flood insurance and homeowners, right, all the time. Many examples. Doesn't cover everything. So certainly we've talked about the pandemic, you know, the dearth of products that cover it. Lots of focus on business interruption coverage. Is it covered or is it not? Many cases it's not, of course, for small businesses, right, when they you know, very much have that need for downside protection. And it doesn't cover everyone. Again, I mentioned uninsured motorists, but the reality is that there's many folks that, again, it just doesn't cover either because there's not a product for them, or it goes back to being too expensive. So I mentioned the lava flow example. Unfortunately, the cheapest land in Hawaii was in the lava flow zone, right? Because it was a lava flow zone. And so people were able to purchase property there at a much more affordable rate than anywhere else in the islands. But again, those are the ones that typically had restrictions on homeowners insurance and didn't cover a lava flow. So the people that need it most, you know, they don't have the ability to get insurance. So if the lava flow went over their home or burned it down, you know, they didn't have any coverage for that. So I'm seeing a couple of questions in the chat. Pat asks, what advice do you have to those that may not be ready or afraid of the upcoming change? You know, really what I would say is you still have expertise in risk. Risk is not going away. Exposure is not going away. The way that we manage risk and exposure, whether it be from a pricing and underwriting of claims, you know, you name it, the way that we do our work, the way that we distribute our products, those things will change and evolve over time. But risk and exposure isn't changing. So you definitely need to be comfortable working with technology, with machines. But I wouldn't worry that it's going to replace you. If you are in a job that can be replaced by machines, it's definitely the time to, you know, kind of think about what you're doing and try to raise, you know, your skill level through programs such as the designations offered by the institutes and many others. So again, many of you have already done that. You've made that investment in your professional development. So I think those that continue to invest, that phrase lifelong learner, we've used a lot as a CPC society, and I think that's never been more apt. There'll always be a need for our knowledge and expertise, but it can't just be doing the same thing all day, every day, because that is the type of work that can be easily automated. So I mentioned expense ratios and technical debt, this whole idea that, you know, it's kind of like a credit card, and like, you know, your failure to put an appropriate investment in your technology stack can come back to bite you over time. You know, I was talking to a group over in the UK, and an analogy a gentleman used there was, he said a lot of insurance firms, and that could be on the agent broker side, that could be on the carrier side, TPAs, you know, they've really only invested in what he termed, right, enough to keep the lights on, right, enough to keep these machines running, but they haven't made a strategic investment to replace a lot of these. And you've heard a lot probably about digital transformations and the need to upgrade core systems and things like that. And that's really why, because over time, while the actual cost of operating it, a fully depreciated, machines and software can be low, you're kind of artificially bringing your expense ratio down, like you're not reflecting the true expense of those systems. And so they're incurring some hidden expenses over time that then can become reality. That a lot of folks are trying to put out new and innovative products in the marketplace, and they realize that their systems just can't handle that, or to do so, it costs them $1 million or more simply to offer a niche or specialty product for those that need it. I found this article very interesting from the Financial Times. This is from June of last year. And as you know, auto insurance has not been particularly profitable over the last 5 years. A lot of distracted driving, right? It used to be the frequency was going down, severity was going up, and then the frequency kind of leveled out and started going up, and severity, it kept going up and up. To replace the bumper now, right, with all the sensors, right, costs $5,000 instead of $500 to get some dents, things like that. So just like it's been a challenging line here in the States, it's been challenging overseas in the UK. And so the German insurer Allianz came in and actually in one day acquired two motor insurance carriers in the UK, LV and Legal in General, and they became overnight the second largest motor insurer in the UK. So the Financial Times article was kind of, puzzling a bit about this, like, why is Allianz making such a big play to get into a line that's been, fairly unprofitable over the last few years. So very interesting article, but if you kind of read down to the bottom, the folks at Allianz said, these companies in the UK, they're running about a 30% expense ratio on motor insurance here. And because we've made heavy, 9-figure investment in technology, we actually think we can offer the same products at a 10% expense ratio. That's a 20-point difference. That's a huge difference between, the combined ratio that they could run at. So at a 10% expense ratio, they could make money in motor insurance in the UK versus those that were struggling had a much higher expense ratio because they had not made the same level of investment in their technology. Another, British publication, The Economist, in July of last year had this kind of, very famous article, "The Future of Insurance is Happening Without Insurance Firms," and talking about, tech and stuff. And so this is always one that I love to challenge folks with, saying, do you think the future of insurance is going to happen without insurance firms or not? I think that's a bit pessimistic. I will say, people ask me all the time, Rob, how come, what's preventing Amazon or Google or Apple or others, Facebook, right, to get into the insurance space? And one of the big things is they don't have the data that we have. So they have a lot of data, of course, but they don't necessarily know how it correlates to claims, to losses. They don't know that much about actual risk exposures the way we do. That intel secret sauce in the industry. We know exposure. We know how to manage it. And so I would push back a little bit on the idea that the future of insurance is happening without insurance firms. But at the same time, again, there's definitely need to make that investment in technology to relevant. So yeah, Pat has a great comment here in the chat talking about we can't provide an Amazon Netflix experience still running on legacy systems. We definitely need to make this investment for the future. Very, very true. And John mentions, having a good partnership between insurers and incoming tech firms. And totally agree, John. I'll definitely touch on that. A great comment. And so actually it kind of plays right into this slide. So this is the challenge, right? It costs a lot of money just to keep the trains running is kind of the phrase that we use. And so keeping the lights on and keeping the trains running, that's always priority number one, and there's always a whole host of problems. Companies now having to convert from Skype to Teams and things like that, right? And so how do you continue to innovate? How do you come up with the new things? I think that's, really, really the crux of the challenge. And the bottom line is you need help. You can't do it alone. This ability to partner is critically important. So, I talked about all the problems with insurance. I talked about this wave of technology that's coming, but in some ways, insurance is actually the ideal product for the digital age. Like, I know it's been around for, centuries, but it doesn't require a huge amount of physical infrastructure. So if you think about Elon Musk and your Tesla and you're trying to compete against Ford or Toyota or Mercedes-Benz, you've got to spend over $1 billion to build a gigafactory out in the desert in Nevada. physical manufacturing, physical infrastructure is critical to compete with those guys. That's why there aren't that many new auto firms that are starting up. But in the insurance space, that's simply not true. Think about how many of us have been able to pivot fairly seamlessly to work in a remote environment because of COVID-19. It's really, at the end of the day, really about information. It's about bits in the computer. It used to be information that was on paper and in files, of course, right? And yes, there's still, of course, a relationship piece of it, a human element. I don't think that'll ever go away from insurance. But if you were to think about getting into a new industry, insurance would actually be one that would be super attractive, and really has been discovered kind of over the last decade by investors, entrepreneurs, et cetera. There's really three main barriers to entry. The need for trust, right? This isn't just a ride from my home to the airport. And if I take it with Uber and I don't like that experience, I can go to Lyft, or I can go back to using cabs or getting a friend to take me. These are big commitments, right? I'm going to pay you premium and you better be there at my time of loss. So the level of trust that people place in their insurance carriers and agents and brokers is much higher, of course, than many of these other consumer products. The reliance on historical data, pricing, reserves, and capital threshold. Certainly, we understand the need for that. We can't just start from scratch and say, oh, I got the pricing wrong on that, so I'll just, go out of business this time, and next time I'll get it right. And the lack of consumer engagement. This isn't a product that consumers or businesses interact with on a daily basis. They're not checking their bank account or their stocks. They don't look at their policy. Hey, is my deductible still $500? Today. It's very much you get insurance. I always say it's the thing you do to do the thing you really want to do. So you get insurance to drive the car off the dealer's lot, or to close on your home, or to start your business. And so once you've done that, usually people don't shop their insurance until one of two things happens. They have a bad claims experience, and certainly a great claims experience can make that person a customer for life. Or if the rates go up so significantly that it's an inducement to shop. But usually, small increases are not perceived as a shopping opportunity. But new technologies are actually emerging that could potentially challenge these three barriers to entry. So for the need for trust, is this blockchain or distributed ledger technology, this idea of smart contracts, and then peer-to-peer enablers, user reviews, social media. You can think about many other ways that we kind of enforce trust in a system when we don't have that strong regulation, that people still trust the system. So again, Uber is a great example of this. I was not an early adopter of Uber, but enough people took it and talked about it. And then I had a bad experience with a taxi one time that tried it, and I really enjoyed it. And kind of reviews and social media and hearing other people got me to try it. I wouldn't have tried it on my own. Historical data. So we've talked about sensors, telematics, the Internet of Things, remote sensing, aerial imagery, smartphones, this use of artificial intelligence. What difference does it make what you drove 3 to 5 years from now if I have a wealth of data on how you're driving over the last 3 to 5 months? And by the way, the last 3 to 5 months is probably more indicative of the current risk, the current exposure, and maybe very different because traffic patterns are different, et cetera. We know that there's been an increase in severity during the pandemic. So why would I look at such old and historic data? Cyber insurance is a great example of this. People have told me, rating cyber insurance on data that's 3 to 5 years old, those threats change hourly, by the minute. Like this morning could be fine, and this afternoon there could be a ton of activity on the dark web. And in theory, you should kind of charge cyber based on that, based on kind of the current threats, current exposure, not what happened years ago. And then the lack of consumer engagement, a lot more on digital marketing. I talk about the revenge of the independent agent. It used to be the Geicos of the world are spending over $1 billion on advertising. How is a small independent agency ever going to compete? But now with social media, very strategic digital marketing through Google AdWords, through Facebook, Instagram, and others, you can very much tailor your audience, make it a niche audience, and spend a fraction of what a Geico or Progressive are spending, and still generate a lot of leads and engagement. Chatbots are getting increasingly popular, and they can be deployed either on a website or through texting. And sometimes it feels like you're talking to a real person. It's not as wooden as it used to be in the past and allows communication at scale. And then, of course, there's a lot more focus on user interfaces and user experience. People are talking about customer experience in a way that I don't remember them ever talking about in 25 years in the insurance industry. So Craig mentions fourth barrier to entry regulation. I think that one's kind of interesting because I always felt like the regulators are, they're very interested in regulation and they're interested in some of these startups. And I think startups sometimes get away with things that big carriers, couldn't get away from. So I think it's very interesting. AI, I know, the New York DFS had kind of said your AI has to be, we have to be able to see all the variables and see how it's coming out with the outcomes that it is. And a lot of these AI technologies are what are known as more black box, where you don't get that level of explainability. And so, is that response innovation, very, very interesting to see. And of course, right, there's all the other regulations that we've all had to deal with on a day-to-day basis. Matt talks about, anything we said that new carriers starting to threaten the market share. The big mainstays doesn't really happen. That would greatly reduce the incentive of the big guys to retool and innovate on their own. I think that one's really interesting. Obviously a lot of hype about Lemonade. They had their successful IPO over the summer, and State Farm kind of famously had a commercial that was throwing shade at Lemonade. People are saying, "You're State Farm. You don't need to respond to these guys." But I actually like the fact that insurtechs are both focused on enabling carriers and agencies and brokers to do better, but that there's also this outside threat from companies like Lemonade, like Hippo, and others to hold us accountable. And so I think you're right. And I think if that kind of goes away, we are starting to see consolidation among both carriers and agency brokers. Think about Aon and Willis Towers Watson combining. So it will be interesting. You definitely see the big getting bigger. Is there room still for some of the smaller players? That remains to be seen. I think you'll definitely see some consolidation over the next decade, but I also think that small, nimble firms will be able to survive. And then I've got another comment here that talks about the problem still about data security. Can't be 100% digitized, but all the information will be bad things. IoT to be controlled by thefters, et cetera, is still a big problem. Absolutely. Data security. Hacking, ransomware is run amok. I talked to a group that are risk pools for cities and counties and states last year, and I was not aware of how big the ransomware problem was. Actually, in Hartford, they couldn't start school on time this year because of a ransomware attack, and they actually said that they had made investments in their cyber defense, so they didn't have to pay the ransom. But it's everywhere. And you're seeing more and more of the messaging saying, don't pay the ransom because you're just obviously the same as, don't negotiate with terrorists, right? When you're actually fueling this behavior. Yeah, Sue mentions hackers getting way more sophisticated. So Patrick asked a great question on insurtech. Will they really disrupt, or are they enabling established carriers? So I'm going to wait on that one to the end. I'll teach you guys a little bit on that one. So I have my own personal views, and I think that one's an interesting discussion. So what are the implications of this new insurtech? All the ways that we've kind of done business in the past, and you can kind of see some of the ways on the left-hand side, are very, very different in this future world. It's not so much about collecting the data as filtering through the data. It's not just a point in time, right, at new business and at annual renewal, but it's a continual stream, et cetera, and kind of go down the list. So the bottom line is the way that we evaluate, the way that we quantify, the way that we assess, price and underwrite risk, the way that we adjust claims is going to be radically different, and it is enabled because of these new emerging technologies. So just some very quick examples. Here's one. We've talked about telematics for almost 20 years, right? I know I've taken fleet vehicles in the past where it's just that little red light, and if I went a mile an hour over, that little red light would go on. And if I knew that if that red light was on too long, I would lose my driving privileges for my company to be able to use fleet vehicles. But there's so much more engaging now. You talk about the State Farm ads with Aaron Rodgers, don't mess with my discount, right? Where you actually have some gamification and you have some behavior, you've got challenges, you can actually see the dollar amount that you're saving. You're seeing that in other worlds as well. Contests such as San Antonio Safest Driver, there's been an LA Safest Driver. These are enabled by Cambridge Mobile Telematics, which is a huge player that partners with a lot of the leading insurance carriers. And they've grown up, seemingly overnight in terms of their dominance in the telematics market and some of the capabilities that they have. Real-time first notice of loss. So, here's an example: a hailstorm. Typically, people look at hail swaths. You can get these from Verisk and others, right? Where did the hail happen? But they're not particularly accurate. Hail is very, it doesn't fall in those kind of, bullseyes that we're kind of used to looking at. One house can get really slammed and 3 houses down, they didn't see any at all. So there's companies that are out there that are actually putting devices on top of commercial structures to collect hail observations to be much more accurate than the radar, and to kind of create a sample throughout a metro area to give a much precise hail map. But there's actually another company that's even putting hail pads on roofs, very similar to solar panels. So you can actually tell on that particular house, how long did it hail? What was the density of the hail? It might have been 2-inch hail, but it could have been very slushy and kind of fallen apart versus very dense and really, ping off of that roof, et cetera. And so you could actually text that homeowner right immediately after and say, hey, I noticed that it was hailing at your roof for the last 8 minutes. Would you like to file a claim? These devices are now as cheap as $100 that you could put on somebody's roof. It's pretty powerful technology. And then wearables. So you can kind of see on my right arm here, I've got a wearable here. This particular wearable is produced by a company called MakeYouSafe, and so it collects all sorts of external environmental things such as temperature, humidity, light levels, noise levels. It slips, trips, and falls, things like that. So it would protect me if I were to work in a manufacturing environment or a construction site. It's not tied in with biometric firms, so it's not looking at the worker's heart rate. Are they getting dehydrated, things like that, but it certainly could. I've seen things that look like Apple Watches that measure blood alcohol level, and potentially if you're a trucker or somebody like that, it would actually shut off the engine if that person's blood alcohol level is measured from this device and their skin is too high, et cetera. So there's a whole lot in the life and health space as well that are, you can take a picture of your face and it can tell you kind of, give you diagnosis for things that you have. So it's pretty revolutionary what some of these devices can do. So I know we talk about artificial intelligence like it's this far out thing, right? But we use it in every day of our lives. We talked about GPS before. We talked about, Amazon, the recommendations, Netflix, things like that. And we don't even realize that we're using quote unquote AI in daily aspects of our lives in many cases. We need to be using this in insurance and often are not. I think about underwriters in particular that are capturing data from all over, some quantitative, some qualitative, and are then asked to make a decision. Do I write this account or am I going to renew here? And they enter that information into an underwriting workbench or database of some type. Usually there's no system to kind of enforce consistency. Yes, there's usually some audits, right, and things like that. But we know that each underwriter may weigh those factors very differently, and it's been difficult to do it programmatically or algorithmically in the past. But if you were to feed this type of information to an AI system today, it could actually recommend an action and enforce a lot more consistency, and it can evaluate the risks that you keep or wrote, how did they perform versus those that didn't. It can do natural language processing, and so it can look at notes from a loss control report and things like that. So much more intelligent, and companies should be looking to leverage this data. We talked about claims and talked about processing claims via AI as well. Privacy and blockchain, you heard a lot about it. It's not ready for prime time, unlike AI, but you can see there's several different potential use cases here. And think about it, really it's the agent or broker, the carrier, and the insurer that form a contract, right? Those three parties form the insurance contract. But there's so many more parties that are part of that insurance contract, that insurance transaction, over and above those that form the contract. And so, how do you exchange information back and forth in a secure way to give them only the access that they need to? There's a lot of manual work and checking and verification that happens today. And so, State Farm and USA have set this up where their insureds are in accidents. They basically reconcile. They used to have adjusters calling each other all the day, right, to kind of talk about who's at fault and talk about subrogation. And now they all do it via the blockchain. They've saved significant expenses by doing that, just because they're the 2 of the 5 largest auto insurers in the country, and their drivers get into accidents with each other all the time. So one intriguing use case of many more that I think you'll see, probably more 5 to 10 years out, but some of that work is being done today. So, wrapping up, who will finally drag insurance into the 21st century? We kind of think about our roles, right? And these are very tried and true, but we all have our biases. I certainly do as an underwriter, as a former actuary. And so we really need to work more collaboratively than ever. We need to work kind of in diverse and inclusive teams. And That can mean certainly, race and gender, sexual identity, young and old, but it also means our disciplines, like, what have we specialized in? What is our lens? What is our experience level in the industry? We really need to all come together to innovate. It's not going to take one person from one role to do that. So, in this data-driven world, we're all competing on algorithms at the end of the day, right? And I had a data scientist tell me, if you want to build a model with great statistical fit, just predict nobody's going to have a claim, because we know that, frequency tends to be, 5 to 10% in any line in any given year. So, in some lines, it's even lower than that. So, 90% chance you're right if you say you're not going to have a claim on this policy. And so it's really, there's an art and a science there, and who collects the most data, and then who makes sense of that data more so. A big challenge on the carrier side. I mean, even the agent broker side is, it's not just collecting the information, that's part of it, but making sense of it has been the real key. Use this term less weightlifting, more yoga. We really got to think very modular. And so just knowing we don't know what the future holds, prizing agility and flexibility among other strategic objectives for our firm. And so you can kind of see it applies to a lot of different aspects of your business. But I think it's always been about kind of brute strength in the past, right? How fast is my computer? And we had very siloed systems. If you integrated with another system, you had to build a bridge. It was very intentional. And now we hear about platforms and ecosystems and APIs, exposing your system to integrate with other people, because that person that you want to integrate as a strategic partner 2 years from now may not even exist today, right? As an entity. And so to move in a fast moving world, you've got to be very flexible, very agile. So we kind of get back to Patrick's question on this one. More disruption, more evolution. And I know you guys have heard from Brian Falchuk, and he's got a great book, The Future of Insurance from Disruption to Evolution. Really talks about specific case studies of carriers that have successfully innovated, which I love. I think it'll be both. I tend to be maybe a little bit more on the disrupt side than Brian is. I think there are definitely still some very big inherent advantages to existing players. But certainly, you look at Lemonade, you look at Root, you look at Metromile, look at Hippo and others. There are certainly those that have become successful competing with existing carriers. Pi Insurance is another one in the workers' compensation space. So I don't want to rule that out. And I actually don't, I think a lot of the companies like Lemonade's got a lot of hype, a lot of buzz, but fundamentally what they do is not that different than a standard insurance company. I think they're better at marketing and they're better at tech. Their tech is, not bad, but it's not revolutionary. I think we're still yet to see, again, with sensors, cloud, AI, what is truly possible in kind of the risk quantification and assessment of, exposure realm. So I expect more disruption to come. I think it'll take more in the 5 to 10 year time frame, but we'll see how it all plays out. It'll be very fascinating. So I really thank you guys for your time. I know we have just a few minutes left for questions, so encourage you. This is just a thin slice of the book, so obviously encourage you guys to go check it out. It's got some wonderful reviews on Amazon. That's a great place to look it up. Obviously, you can find more at endofinsurance.com. And with that, I always love connecting with folks, so feel free to connect with me on social media. We can continue the conversation. So just, please add your questions in the chat for the next few minutes until we wrap up. To get to Patrick's earlier, sorry, I talked about the disrupt versus evolution. So Denny kind of talks about, like other industries, the big players are starting artisan companies to get the impression that they're a little scrappy guy. And yeah, you're right. Here comes the new boss, same as the old boss. I would say that too. Like, a lot of these companies at the end of the day, renters insurance, quite frankly, is kind of where Lemonade made their bread and butter. And that was a market that was really not aggressively pursued by many of the other big players. And, they're getting into pet insurance now, but, how are they not going to they offer home, of course, as well, but how are they not going to break into auto and look more like a standard personal lines carrier? It's hard for me to imagine that. What do I make of the failure of AIG's insurtech subsidiary Blackboard? I think there's a lot of interesting startups and a lot of hype, honestly, a lot of the news. And I think one of the reasons that my book has resonated so much is most of the news is basically a press release, and a lot of the publications, right? They get money from sponsors, and there's some great journalists out there and there are some great pieces out there, but it's really hard to distinguish. And so, what's hype versus what's real is really hard to distinguish in this field. And I just think, there hasn't been a lot of success in any industry of somebody kind of, trying to compete with themselves. And so I think it's just very, very difficult to set up those types of subsidiaries like Blackboard. Heather asked about thoughts about willingness of major carriers to partner with tech companies. I think you're doing that, but I also think it's really hard, particularly if you've got, the big insurance and big tech, a lot of egos in the room, right? A lot of misperceptions. Not saying that it can't happen. I think about Google's investment from their VC fund in applied systems, kind of a really big, agency management system. That one's really fascinating to me. Of course, agents and brokers are the closest to the customer, know the customer best, and I know that's something that certainly Google and Amazon really prize. So, I know people focus on the carrier side, but I actually think there's a lot of opportunities on the agent broker side. So we'll kind of see how it plays out. Let's see, I think just scrolling through. So Michael asks, what do we see as the new regulatory risks? Yeah, I think AI is going to be big. We've certainly heard about, bias, which is a major, major concern on AI. I think we have this conundrum where some of the most powerful AI is based on neural networks where you don't have line of sight, you don't have that explainability, you only see the outcomes. But at the same time, so you don't want to stifle innovation, but at the same time, if those are biased outcomes, certainly there's been a lot of questions about income and race and ethnicity and other things, and concerns about redlining in the past, right? How do we know that AI is not redlining? Even if the company has the best of intention, they're not putting those variables in, like it still may be able to kind of bring out some of those things and create that. So I think AI, and then what's insurance? There's a lot of extended warranty products and others. There's a pet insurance company out there that actually, they sell essentially pet insurance, but it's more like peer-to-peer. So they've specifically talked to lawyers and say this is not insurance, so they're not regulated as an insurance carrier. So I think that is going to be an interesting question, just very foundational. What is insurance and what is not will be interesting. So a lot of work on the regulatory side. So many great comments coming in. So let's see, I'm going to ask the last one from Patrick, and then I'll turn it back over. Who will be the first to insure the flying cars? Yeah, that's a great question. Definitely Lloyd's of London, one of the syndicates will probably be the first one. And there actually are some very interesting flying cars out there, certainly not in scale or whatnot. They're more of a hobby, but I would bet that there's already flying cars that are insured out there. So with that, I really thank you so much for your time, the amazing comments and questions that you put in the chat, and I'll turn it back over to Patrick.
All right, thanks, Rob. That was awesome. Thank you for joining us. I think this highlights the power of digital, is that you probably wouldn't have been able to join us from Texas if we weren't virtual. So definitely leveraging the new normal, and hopefully the future of what our world looks like. So thank you again for joining us. Everyone check out Rob's book. Like he just said, he's also offering a discount on it for all registered attendees. So I have that posted on all of our socials. Also, the room for the conferment ceremony, the next link is open. So everyone can jump in there, take a break. And thank you for kicking us off today, Rob.
It's a pleasure. Thanks, everyone.
All right. Everyone, have a good day. We'll see you in a few minutes.